It's no surprise that the Fed has been taking measures to combat inflation. To many people's surprise, these efforts are actually starting to yield results. It's no surprise that the Fed has been doing anything they could to fight inflation. And to many people's surprise, it's actually beginning to work. Like a quick background, all of this began in March 2022, when we saw our first rate hike of 0.25. At the time, this was their chance to signal the end of free money, while mentioning a term that sends chills down every investor's spine: quantitative tightening. Just think of it like this. Throughout 2020 and 2021, the Federal Reserve promised to buy an endless amount of corporate bonds and mortgage-backed securities as a way to stimulate lending. Prior to that, anytime a company needed money or a bank wanted to issue a loan, they would have to rely on selling those loans to institutional investors who would only pay an amount relative to the amount of risk they would bear. But when everything shut down and those investors became cautious, the Federal Reserve stepped in to buy whatever assets were being offered to sale, just to reassure everyone that everything would be okay. Now, obviously, that strategy worked, but it resulted in the Federal Reserve building a portfolio the size of Wall Street bets. So eventually, they'd have to sell, and most of their selling or quantitative tightening these days is simply getting paid back for loans and not reinvesting the proceeds. As a result of this, yields have increased, asset values have fallen, and subsequently interest rates have skyrocketed faster than ever before in history. This brings us to the question of how well everything is really doing. Well, according to inflation, things are actually improving substantially. The latest report as of June 13th showed that inflation came in at 4% year over year, which is the lowest reading since 2021. Month over month, it also worked out to be 0.1% increase, leading many people to believe that the fight against higher prices is actually working. However, I must say that even though the overall report looks pretty good, there are a few points of concern, namely core inflation, which excludes food and energy prices, is a bit stickier than expected, hovering around 5%. This means that outside of food and energy, prices are still increasing on a day-to-day basis, albeit at a slower pace than before. It's a slight improvement over the last month's consumer price index, which came in at 5.5%. So at least it's moving in the right direction. Additionally, a chart shows which categories in our economy are experiencing the largest price changes. Now, with inflation beginning to subside a little bit, the markets are absolutely loving it. This leads us to the stock market. At first glance, yes, the S&P 500 is up over 14% year to date and more than 16% year over year. However, once you delve deeper, you'll realize that most stocks are not performing as well. CNBC points out that the overall index is really driven by just a few stocks that are seemingly doing increasingly well. The rest of the stocks are not faring as positively. It's worth mentioning that the stock market's heavy reliance on a few large companies is not an unknown phenomenon. Throughout history, the composition of the largest companies leading the market has constantly changed. A finance professor at Arizona State University conducted a study analyzing over 26,000 stocks since 1976 and found that the average stock traded for only 7 years or resulted in a loss. Moreover, the most common return for individual stocks over their lifetime is a loss of 100%. Only 48 38% of stocks delivered any positive returns, and a mere 4% of publicly traded stocks made more money than a one-month treasury bill. Despite these statistics, the current market conditions are considered normal. Throughout the last 100 years, a small percentage of stock accounted for the majority of profits. This underscores the fact that the largest companies consistently change over time and lead the market towards profitably. Moving on to the housing market, recent reports from Redfin indicate that higher mortgage rates have restrained homeowners from listing their properties. The national level data suggests that homeowners who have locked in historically low interest rates are reluctant to sell and acquire mortgages at higher rates. Consequently, new listings hit their lowest level for any June on record, which limits home sales and keeps home prices stable. As a result, home prices are down only 1.6% year over year. When considering specific markets, areas such as Austin, Texas, Oakland, California, Las Vegas, San Francisco, and Phoenix have experienced the largest declines in home prices. On the other hand, cities like Cincinnati, Miami, Milwaukee, Fort Lauderdale, and Virginia Beach have seen increases ranging from 4 to 13%. For individuals waiting on the sidelines, hoping to prices for fall, there is some positive news in the rental market. Due to a recent construction boom, there is a higher number of new rental units available than at any other point since 1973. This surplus of inventory has led to lower rents in some areas. A Redfin study revealed that only 4 major metropolitan areas currently offer a more affordable option to buy that rent: Detroit, Philadelphia, Cleveland, and Houston. In most cities, the cost of owning a home at a 6.5% interest rate could be double the amount paid in rent. However, if mortgage rates were to decline to around 4%, the cost of renting would begin to level out. Regarding the Federal Reserve's stand on rate hikes, they currently and recently announced a pause or a skip in rate hikes for the month of June, concluding a streak of 10 consecutive rate hikes since early 2022. However, it's important to note that this does not mean we are entirely in the clear. The Federal Reserve remains ready to raise rates again if inflation shows no signs of slowing down. They have had just projected 2 more rate hikes, equivalent to a quarter percentage point each, before the end of the year. This would bring the federal funds rate to 5.6% in the next 6 months. While this announcement was unexpected and higher interest rates could put downward pressure on the markets, it serves as a clear signal that more rate hikes are likely, with July and September being potential months for increases. The Federal Reserve aims to continue hiking rates until there are clear indications of inflation subsiding. Like and subscribe for more interesting videos. See you next time.